Let's get more on the markets as investors contemplate more quarterly earnings and economic data, including that key jobs report later this week. For that, we want to bring in Gabriela Santos. She is global market strategist at JPMorgan Asset Management. And Gabriela, you were here when we were just talking about interest rates, what this means, the higher interest rates. Is this right for people to jump in and say, OK, we're going to buy this jump in yields that we're seeing at this point? Or do you think this is a little bit trickier here?
So we look at it as an opportunity. Look, the bond market sale has gotten extended at more favorable prices than we had been expecting. And we would be looking at it as an opportunity to move from what we find is a very heavy concentration in cash, record levels in sitting in money market funds, into building a long-term fixed income solution, which is not cash. So we would be looking to increase duration. There's no need to go all the way to the other side of the spectrum and be looking at the 10-year or 30-year. Really, we're speaking about having a more neutral approach to duration, which is 5 years, 6 years. And actually, when you look at bond auctions, that's been the most heavily subscribed part of the curve from investment managers. It's really that sweet spot where you can lower your reinvestment risk, meaning you can lock in these attractive yields for a period of time, and you can benefit from the price appreciation when they fall over time. So the risk reward in fixed income to us is looking really, really attractive, just looking at the core fixed income part.
I get the sense, though, a lot of that money that's sitting in cash on the sidelines has probably been waiting for some sort of a pullback in the market. We've seen some pretty phenomenal returns for the year. August, not so hot. You're talking about the S&P down 3.5%, the NASDAQ down by 4.5%. But if you look at where the S&P is sitting, it's at 44.33. That's where it closed yesterday. So even with a 3.5% pullback, that may seem a little rich for some people. Or, look, is this just the new reality? You better jump on board if you expect any of this. What do you tell people when it comes to stocks?
So I think when we look at the money market part of it, we think about allocating to fixed income just because it actually has some income. It has a role to play now. And we could even be speaking about equity-like returns as prices fall. On the equity side, I think we've come a long way, right? We're now talking about pullbacks in the market as opportunity. We don't see a widespread fear when we speak to investors about returning to a bear market. So really, it's speaking about opportunities. Our main conversation here is we've become more constructive since late May on the perspective for the economy and for earnings, now expecting a soft landing and the earnings recession to be behind us. The difficult conversation we have is how do you actually implement that in the stock market?
Well, is this a pullback, what we've seen in August?
We
is that
think
enough of one?
We think it's an evergreen pullback, so going more to thinking about it as 5% pullbacks once a quarter is normal, 10% once a year. We actually haven't quite gotten 10%, but looking at it as opportunities. The trick is soft landing does not equal buying a passive S&P 500 or NASDAQ because it has run too much, frankly, if you look at the heavy concentration of the largest stocks. So we have a much more nuanced conversation about translating a more positive view into a more active approach, and specifically in sectors we think are interesting cyclically, but also more structurally. That includes parts of healthcare, actually, but it also includes industrials. It includes different types of tech adjacent companies that are not just the 7 largest ones. And it includes other markets overseas. We've seen a lot better reception to that theme recently.
Very quickly, healthcare includes pharmaceuticals at this point or no?
Not at this point. The sector is already the subsector is already underperformed significantly given the policy uncertainty. The date to watch ahead is early February when the results of those so-called negotiations come to fruition. So a lot of pressure until then. Healthcare, more interesting subsector is medical technology. Now they're all returning to doctor's visits and exams, and that's a sector that's seeing a lot of positive tailwinds.